Audit assertions are the implicit or explicit claims and representations made by the management responsible for the preparation of financial statements regarding the appropriateness of the various elements of financial statements and disclosure. It is regarding the recognition, measurement, and preparation of assets, liabilities, equity, income, expenses, and disclosure in accordance with the applicable financial reporting framework. For example, if a balance sheet of an entity shows buildings with carrying amount of $10 million, the auditor shall assume that management has claimed that the buildings are recognized in the balance sheet exist at the period end, the entity owns or controls those buildings, the buildings are valued accurately in accordance with the measurement basis, all buildings owned and controlled by the entity are included within the carrying amount of $10 million. Here is the type of assertion. Well, assertion itself may be classified into the following types, which is assertion relating to classes of transaction, assertion relating to assets, liabilities, and equity balances at the period end, and assertion relating to presentation and disclosure. But I will only focus on the assertion relating to the assets, liabilities, and equity balances at the period end, which is assertions address the assertion of whether ending balances of assets, liabilities, and equity interest included in the financial statements actually exist at the date of the financial statements. Auditors will often vouch the existence by starting from an ending balance of an account and finding the supporting transactions making up balance. This means the assets and liabilities really do exist and there has been no overstatement, for example by the inclusion of fictitious receivables or inventory. This assertion is very closely related to the occurrence assertion for transaction. For example, auditors have to make sure that amount recorded in the balance sheet exists. We do have cash. Management say that we do have account receivable. They exist. We don't make this up. So what an auditor is trying to do is, of course, they try to get an evidence which that is amount indeed exists. They have to prove that. Let's say an auditor is looking at account receivable. So an auditor will try to get an account receivable and extra balance. So let's take the sample of customers' account balances and confirm those account balances. But the confirmation is about getting a third party verification from the customer. Say, yes, we do owe XYZ company with this amount of money. So that's evidence saying that the account exists, because a customer is not going to confirm any account if they are not exist, not owed you any money. That indeed is strong evidence saying that the account exists between. Well, financial statement assertions has always been an important of the syllabus for audit examination. To ensure auditors pay appropriate attention to the disclosure included within the financial statements.